Broadcasting live from the Business RadioX studio, it's time for the GNFCC 400 Insider. Connect, build, and grow with the Greater North Fulton Chamber of Commerce.
Good morning, everyone, and welcome. We are excited to have you join us today. We ask you to please keep your microphones on mute so we can avoid any background noise. And if you have a question for our presenter, we would ask you to use the chat feature. We will be addressing all the questions at the end of the presentation. So that's the method that we'll use. And we'll cover as many questions as time allows. I'm Callie Boatwright. I'm the president and CEO of the Greater North Fulton Chamber, and we're delighted that you took an hour out of your day to join us, especially on a Zoom webinar. I know that we're all have an abundance of those lately. I feel like you're really going to enjoy this one. I will tell you that Gregg Logan is our speaker today, and I had the pleasure of hearing Gregg's presentation a couple of weeks ago and thought it was absolutely stellar and information that I wanted to bring to our folks here. And so Gregg was kind enough to say yes when we asked, and we're just delighted to have him here with us today. I also want to thank John Ray. We'll be taping today on Business RadioX and making that available on our podcast. So without further ado, I'd like to introduce Gregg Logan, who is an RCLCO Managing Director based out of Orlando, Florida office. He has more than 35 years of development and consulting experience. Gregg has worked with real estate developers, landowners, cities and counties, private investors, builders, and legal and accounting firms. Gregg's consulting work has included market and financial evaluations, fiscal impact assessments, economic impact evaluations, economic development strategies, valuations, and litigation support for a wide range of real estate product types. Gregg is incredibly knowledgeable, and I'm really looking forward to what would be a 2-week later presentation, as I know these are constantly updated. Gregg, welcome to the Greater North Fulton Chamber. We really want to thank you and appreciate you joining us today and are very excited about your presentation.
Thank you. Nice to be here. Nice to be with you. I've shared my screen. Hopefully you can all see that as well. Are you seeing my screen now?
Yes, we can see it.
Okay, great. Terrific. Well, let me jump in, and I guess we'll have time for Q&A at the end, correct?
That's correct. If everybody just wants to use the chat feature, then you will be able to put in questions, and Gregg will bring them up at the end and see how many we can get answered.
Great. Okay, well, I'll jump in. So this is a moving bit, and we are real estate advisors and work with both developers and investors and builders. And so we're trying to keep up with all this information, keep it as real time as possible. Some of what I'm going to share with you was put together at the end of April. Some of it is current as of yesterday. Sort of depends on when the information is available. But what I was going to share with you is start off with sort of, where are we in the health crisis update very briefly. Look at the employment picture, since the employment obviously creates the context for everything else that we're doing. Share a little bit about our point of view on the timing of the recovery, what we think that looks like. And we've also gone out and polled real estate industry participants and asking them how they're doing and getting a sense of which segments of the real estate market are being affected and how. So we'll talk a little bit about that survey that was just recently done, and have a little bit of a quick overview on a few real estate sectors, multifamily for sale in particular, and then open up for Q&A. So real quick, just to sort of get a sense of where we are and how we stack up in the world and here in the U.S., this just shows the confirmed daily cases of the virus for the top 10 countries that are most affected. And you can see the U.S. is up there on the top in the green, which is the bad, which is that we have such a high number of cases The good news is that the shutdowns in particular have been effective, and you can see cases declining. Although it's been kind of spiky, at least the trend is from about 30,000 new daily cases to around 20,000. Still, very high, but trending in the right direction. This shows similar information. Just looking at it's been historically again just for the U.S. and you can see where we started out very low, very few cases back in March and really spiking in April, but again on the decline somewhat. Sobering, to have close to 1.4 million cases and close to 85,000 deaths in the U.S. Just for context, what does this mean in Georgia? Almost 34,000 cases in Georgia and about 1,500 deaths to date. And then the map is current as of yesterday. So more importantly, where are we going? What does it look like going forward? Most of the models do show the trend of of deaths as a result of the virus declining. That shows really from April 1, May 1 in the middle of the graph there, and then June 1 on the far right side of the graph. A lot of different models. A lot of these models are based on the shutdowns and the effect that had on slowing the spread. So the latest news is that these models may change somewhat based on the reopenings, which are expected to accelerate things again somewhat. Well, I guess we'll see how that works out. In terms of what's going on in the economy, close to 3 million new unemployment claims as of yesterday. So we're at about 36 million overall just in the last 3 months, which is really unprecedented and a big shock to the system. I think what we're all hoping is that although this is unprecedented and we're seeing the job losses really dramatically as we're going into this crisis, that because of the fact that hopefully we'll get this under control and that the economy was relatively healthy going into this, is that it will have a shorter life and the recovery won't drag out like it did with the Great Depression or even the Great Recession that we had in 08-09. The unemployment rate has gone from about 3.5% back in February. Officially in April, from the Bureau of Labor Statistics, it's at close to 15%, but we think there's some errors in the calculation there. Unfortunately, errors that likely make that rate higher. It's more likely in the 20% range. And you go back, to previous Aprils, you have to go back to 1948 when we were at about 10.8% to find anything as high. So clearly the highest level since the Great Depression. And the chart on the right just shows the share of the population that's currently employed. So if you are currently working, you are part of the fortunate 50% that's continuing to work. You can see in the gray bars there previous recessions. So you can see the immediate previous recession of where we dipped below 60% employed in 08-09. Clearly, this is a much greater impact. Just looking at where those losses are, construction pretty hard hit with close to 1 million jobs lost as of yesterday. Manufacturing, retail, pretty significant hits in business and professional services, as well as education and health services. But really, the big loser in all this has been leisure and hospitality, with tourism being dramatically impacted. And then the chart on the right shows what the level of past recessions has been, the maximum employment decline during those past recessions, how long they lasted, and then the peak unemployment. So you can see that as of last month, whether you go with the official rate of about 15% or the more likely rate of 20%, this is fairly unprecedented. And that creates some context for this conversation. Is we're going to share our predictions are and how we think it plays out. But this is new territory for everyone. In a recent survey, this is as of last week, talking to people who have been laid off and their expectations of how likely they think it is that they'll be rehired after the home orders are lifted. About 77% saying they believe they'll be rehired. The very likely, about 58%. Some economists are saying, that may be a bit optimistic. And there've been a few, big employers out there like GE, Nordstrom, MGM, and so forth that have suggested that some of the layoffs, maybe have a longer life than that. Again, we don't know. But the highest prediction, Friedman Institute at University of Chicago, saying they're thinking, maybe as much as 42% of recent layoffs could result in some permanent job losses. I hope that's wrong, but that's something we need to keep an eye on. As of yesterday, looking at the different economists and their consensus forecast of where we think the gross domestic product is going to be over the course of the year. As of a few weeks ago, they were saying they thought that somewhere in the close to negative 5% loss. That bumped it up about almost 7%, 6.6%. And then the economists are always asked to grade their forecasts as, is there more upside or downside in your forecast, or is it about balanced? You can see in past forecasts going back to 2018, the thinking was there was a lot more upside in the forecast, and right now the economists are saying this is what we think it is. It, unfortunately, could be worse. There's more downside risk than upside risk. So we're taking all that into consideration and plugging that into our own models, and we've had sort of three possible scenarios for what we think the recovery looks like. One we're calling the summer V, which is the one we would all hope would be the case. Is that we've taken a big hit in the second quarter of 2020. By fourth quarter 2020, we're seeing the economy recovering a lot of its lost energy. That may be the more optimistic scenario, but certainly when we look at the patterns of past recessions, it's a possible scenario. For example, we go back to 2001. The fall U scenario in the blue line there, that's it sort of says we don't really get back. It's a little bit shallower climb out of the recession, that we still see things starting to click up by the fourth quarter of 2020 as opposed to the third quarter of 2020 in the summer V scenario. But by the fourth quarter of 2020, we're seeing things tick up a little bit, and we're back to somewhere close to our 2019 levels by the first quarter of 2022. That would get us closer to about a 5.9 loss in GDP, and as you just saw, economists have just upgraded their forecast from 4.9 to 6.6. So this is right in the middle of that, where we were a couple of weeks ago in the most recent. And then the one where we're sort of calling the Nike swoosh, which is more protracted, a deeper recession than what economists are currently calling for. This one is not the case, but that's where we get a little bit of growth, and then with the job losses, things slide a little bit, and we don't really see us climb out until really we're still recovering through 2022. We've polled people on a number of occasions in the last few weeks in the real estate sector, asking what they think the most likely scenarios are. Unfortunately, few think it's the more optimistic summer V. Only about a third think that we'll have the swoosh. The fall U, which is again our most likely scenario of what we believe is the most likely outcome, is the scenario that has the most support from the 3,000 or so folks that we've been polling, primarily real estate industry, C-suite, about 50% C-suite, another 25% senior executives within our real estate sample. Again, there's the fall U. as any. We don't have a crystal ball, but that seems to be the most likely scenario. So I want to share with you a little bit of the survey results. We went out and again we do a sentiment survey. We're updating this now. We did kind of a limited survey to get a sense of what participants are seeing out there, and we talked to people across different real estate sectors, from hospitality down to industrial, and these are listed in rank order of sort of most severe impact to least severe impact based on the survey responses. And you can see hospitality, retail, regional mall, resort residential, retail, big box power center, lifestyle retail, all there at the top of the chart in the most severe categories: senior housing, office, student housing. Kind of in that middle range of a little more moderate impacts, and then getting into more convenience necessity retail, which would include grocery and for sale residential rental apartments, healthcare or medical office, and industrial space. Really in the more moderate impact zones. We also asked people, what do you expect to be the impact on your ability to secure capital for your real estate activities? And we asked that for, funding of existing projects under construction on one end of the spectrum, and on the other end, securing construction debt and new developments. And you can see that at least when this survey was done a couple of weeks ago, most expected to be able to continue to secure financing for projects that are underway, or for refinancing or recapitalizing stabilized income producing assets, but a little bit less optimistic about securing debt for new planned developments. And we've heard this in our practice just in the last few weeks in talking with folks, initiating new developments. We're involved in a few new multifamily developments in the Southeast, for example, and those that have private equity behind them are moving forward, and those that are looking to secure debt financing from banks have struggled. This is looking at where rent collections were just this last month by a different type of real estate asset. So apartments in the low 90% range, office space in the mid 80% range, industrial space. Really, industrial is pretty mixed because you have the bigger spaces that are controlled by some of the bigger organizations like Amazon.com and so forth. They're obviously doing very well, but then you have some industrial space that has smaller operations, mom and pop operations, and so forth, and many of those are struggling. So it's sort of a mixed bag. Retail somewhere in the 30 to 50% range. Clients of ours that are big in the retail space tell us, LA Fitness isn't paying their rent, Cheesecake Factory is not paying their rent, and so forth. And so, in fact, one of the few that one of our clients said that he's still getting rent from Starbucks, but a lot of his other tenants just aren't paying rent right now. And then on the hotel side, as not as rent, as a percent of revenues, hotels are anywhere from 0 to 30% of typical revenues that they would expect. We're paying close attention to what's happening in the multifamily side of the business, and 80% of apartment households made a full or partial payment by May 6th for May rents so far, and you can see how that compares to 2019 on the chart on the right versus 2020. Not a whole lot different yet. So knock on wood that continues to be the case. And as it says in the chart, the May rent collections were actually a tiny bit higher than what they were the first week in April. And then looking again at what we've seen for the most recent national multifamily housing, for the month of April preceding this, again was pretty strong. Dropped a little bit from. thinking about what's happened in past recessions with multifamily apartments in terms of how long rent declines lasted and what the decline was in terms of amount of rent that was lost during that period, and then how fast that recovered following that decline. You can see that in the 01 and 08 recessions, that we lost between 4.5% and 6.5% in rent. That lasted about 7 quarters, or about a year and a half. But then the rent growth that followed that period, was in that range of 3 to 4%. So not bad. And during the course of the recessions, in terms of how much rent was given back in concessions, in terms of free rent, between 9 and 11%. Markets that had pretty significant declines, either in 01 tech bubble or the Great Recession, the real estate led recession in 08. You can see the Metro Atlanta, Sandy Springs, Roswell, Georgia area where you are. Unfortunately, was one of those areas of the country that had some of the largest declines in both recessions, with rents declining about 13% in 01 and Metro Atlanta about 11% in 08. The minimum occupancy fell 93, 1% in 01 and down to a little less than 89% in 08. And then concessions in terms of free rent in Atlanta, Metro, and in the last recession was about 15% of rent, which compared to about 16% back in 01. So it'd be a surprise for us to do better than that this time around. We'll see. But that gives us a benchmark for what we should be thinking about for those of you who may be in that space. I want to switch for a second to the for sale market and looking at where that's gone. This is looking at April data on what happened to traffic, and you can see traffic really fell off the map there in the last month, and new home sales kind of big stall. Where do we think that's going? This is data from just the end of the month here. The May data is not out yet, but the Moody's forecast for last month, the expectation that home prices will come under some pressure, that we should expect some declines later this year and early next year. But it's in the low single digits, a few percent. Looking at on commercial real estate prices expected to decline much more significantly, particularly on the retail side than the for sale housing market. In terms of where we think housing supply and demand is going, this shows both starts in the red line and sales in the green line there. And it looks like we've, in the second quarter of 2020, we're taking a hit in the 40% range from the first quarter pace, where we were actually up significantly. So we're down about 40% overall. And Fannie Mae's forecast is that we start seeing an uptick there by the third quarter of 2020, and gradually climbing out from the fourth quarter of 2020 and getting back to where we were in the first part of the year, back in end of 2019, beginning of 2020, by the fourth quarter of 2021. So kind of a slow climb out between now and the end of next year. We went out just last week and we talked to the top 50 master plan communities nationally, like the Peachtree cities of the world or the Windwards, and just to kind of see what was happening there. We talked to about 50 communities, the developers of those communities. And what was interesting was their sales were dramatically off at the end of March. And the first 2 weeks of April were pretty bad. So we're really pleasantly surprised to hear that new home sales, at least in these master plan communities, which may represent a flight to quality, but sales in the last couple of weeks were up 30 to 40% over where they were in the first 2 weeks of April. And some communities were telling us they were up as much as 80% from from where they had been. So we look at this and see this in terms of the for sale housing market as some reasons for optimism in May as some of the stay-at-home orders begin to lift and traffic is back up. Traffic is off 75% in most communities across the country, and obviously higher in places that have had stay-at-home orders. Although sales have picked up, cancellation rates continue to be somewhat of an issue. On average, cancellation rates are typically in the 7 to 8% range for new homes, up to the 20 to 30% range more recently, averaging somewhere around 20%. And not just that there's more cancellations, but there's fewer sales to divide that against. And the way market participants are looking at that is about 50% of that is due to the virus impacts, 30% due to job losses related to what's happening to the economy, and about 20% being more than normal. For new home communities that have a vibrant online virtual shopping setup, their traffic is up 1,000% or more, and physical traffic was up about 15 to 25% in late April or early May. But foot traffic is still way down. But we're even hearing communities tell us that they're having some people home sight unseen, particularly from hard hit areas like New York, and relocating to places like Florida. In terms of what the real estate practitioners in this space are telling us, they're a little bit more optimistic at the beginning of May than they were at the end of March and early April. It's interesting because consumer confidence, according to the Conference Board, really took a hit in April. But some of the folks that we interviewed in the last week or in the for sale housing market told us they were seeing some positive impact on consumer confidence, and some consumers that have been sitting on the fence getting back in the market. There's still some concerns that some of the job losses really haven't fully played through the economy yet, and whether or not this uptick that we're seeing is sustainable is still a question. But for the most part, developers are continuing to spend on developments that are already underway. They're pausing on starting new development projects. Builders seem to be continuing to move forward on existing commitments with developers, but in most cases, asking to push their takedowns off by 30 to 60 days. We're seeing a lot of builders, really slowing down their spec home activity, although some, David Weekley Homes, for example, are making sure that they have at least some inventory in all their communities. New ways of selling homes, with the stay-at-home orders, have been a lot of innovation out there, and I think we'll continue to see a lot of innovation and a lot of demand for property technology growth, and some speculation that coming out of the downturn, even now some people are reporting that they're getting people coming out of apartments who just don't want to be in higher density living and want a little more space, and some speculation that this overall will be good for the suburbs, that people are going to want to get away from density. There's really not a lot of good data on that yet, so we'll see how that plays out. We don't know, but things to watch. In the meantime, what does shopping look like in America? For most retail categories, it's not been a great time to be in retail unless you're in grocery, or unless you're Instacart, who has seen just a surge in demand for their services. But every month of this crisis so far, more people have been spending more on ordering groceries online, and you can see that even though people haven't been going into the physical stores, that there's been a big increase in some other store categories that are overall hard hit, but big increases in online e-commerce, which again is just a segment of the market, but at least in e-commerce you can see pretty significant growth there. And I guess we're all wondering what dining out looks like. If you're like me, you've been going to this restaurant where you have to put all the ingredients together yourself. And it's a wonder that place can stay in business, aka my kitchen. This is a little interesting, innovative solution in Amsterdam. There, we'll see what restaurant looks like in the future. But one of the things, as restaurants are being asked to space people out more, is thinking about turning restaurants into something between a restaurant and a food truck. Taking advantage of parking lots and moving tables outside is something else that we're seeing. With that, I will stop and entertain questions.
Thanks, Greg. There is a question in the chat box. What do you expect in residential and commercial DNI appraisal values? And also related, what do you see with lender requirements for LTV and debt service coverage requirements?
It's a lot of question there. I think appraisals are difficult. If we're talking about residential property versus commercial property, I think on the commercial side, it's really tough to do valuations right now. And I think we'll see, transactions really slow down as a result of that. On the residential side, it really depends on where you are. We're seeing, some renewed strength in the master plan community space and the right to quality there. Overall, if we do see price declines of 2 to 3% this year, hopefully not higher than that, but because of some softening on the resale side, that may make it hard. That will probably be show up in appraisals. We just haven't seen a whole lot of data on that yet. Our hope is that with in the resale housing market that we're tight. Our occupancy levels were still historical highs. A lot of people pulled their homes off the market in March. Decided to put things on hold, and obviously sort of helps them hedge their bets. Maybe they didn't want strangers walking through their house and coughing. Totally understandable. But that just leads to a tighter market overall. With builders, with going into a situation with inventory pretty under control and slowing down their construction of new specs. And sales, at least as of the last couple of weeks, picking up. All that is going to have a positive impact on prices. So, how much of a decline in real estate values we see, I don't think we'll have a significant decline. And there's laws in place that are there to keep is kind of where they are. So, maybe we're flat to losses of a couple percent. We are worried about lenders, increasing lending requirements. When we went out and looked to see what's happening with new home sales just in the last couple of weeks, we heard reports that the most affordable end of the market, the first-time buyers, were really not coming back and were most affected. But at the same time, as we talked to communities, they were telling us that their most affordably priced new home product was performing the best in their community. A lot of what they're seeing out there in the communities is a lot of local move-up. Relocations obviously have slowed down dramatically, but the market is continuing to move forward. So I think it's important as we read all the bad news in the press to remember that the market has not really shut down. There's still a viable housing market out there.
Are you seeing any increasing foreign capital demand for U.S. real estate properties?
There really hasn't been any new data on that. Our sense is that may pause somewhat. The U.S. right now has the most cases of the coronavirus. So we're of the 10 countries that are most affected, we are far and away the most affected. So that's likely keeping some people on the sidelines, at least temporarily.
Got it. You had mentioned banks earlier. Are you seeing any slowing of jumbo loans or equity lines of credit by banks?
We've seen lending criteria get a little tougher, a little more scrutiny, and that's affecting the first-time buyer market in terms of particular types of loans. I'm not aware that there's been significant changes there. Maybe someone else on the call comment on that. Where we've seen the most impact so far has been on construction lending for new developments.
When you're talking about construction, commercial, one of our members here mentioned industrial projects. Can you comment on the industrial sector?
Yeah. So, our overall read is that the industrial sector, distribution and logistics kind of space in particular, which is pretty important to the Atlanta region. That the I-80 corridor, from Atlanta up into the Carolinas, pretty significant, and you have the whole Johns Creek area out there, and our sense is that overall industrial is a net winner coming out of this event. That and retail and hospitality, maybe more challenged. The thing we have to remember is that there's a lot of small businesses that are in industrial or business park type space, and many of those companies are doing manufacturing, light manufacturing, are experiencing job losses, and so that's impacted the industrial sector. In terms of the what happens to the industrial market overall, there's a good chance that the industrial market grows by 5% over where we were, not just because of natural growth, but because of the obvious fact that just in time hasn't worked out so well. That not having inventory on hand has turned out to be a big problem, and so I think we're going to see a growth in how much inventory is kept on hand and how much inventory is kept closer to where manufacturing is happening, or how much inventory is kept closer just to grocery and drugstores. So they're not, we're spending a lot of labor right now on restocking. And if we just had more product placed close to where the demand is, we wouldn't have that. And that fact is not being lost on people. There may also be some reshoring or more onshoring, and the idea that we depend on China for all of our manufacturing and ship stuff over here. That's turned out to be not such a great model. We thought we were saving a lot of money in terms of labor costs, but look at how much money we're losing by the fact that we can't get products or we can't get materials we need to manufacture a simple product. So I think all of that suggests that the long-term outlook, particularly for the larger end of the industrial market, bigger players in that space, will be a bigger market coming out of this. But we don't want to minimize the fact that there are smaller industrial distribution spaces out there and smaller manufacturers and so on that are being hard hit right now and are struggling to pay rent. And so it's kind of a mixed picture. I'm out of this, and the industrial market comes out of this stronger, but don't want to minimize the fact that there's some pain out there now.
Well, in relation to supply chains, are there any thoughts about real estate related to, upping those or, with warehousing and things like that?
Sorry, you cut out from me for a second there.
Oh, I'm sorry. Yeah, there was a question about real estate related to supply chains, warehousing.
So that was really what I was addressing just a minute ago in terms of real estate related to supply chains and warehousing. I'm including that as part of the industrial market. So industrial includes, light manufacturing, distribution, logistics kind of space. I think what we're seeing is that there's a great need for more in the way of housing logistics space and closer to population centers, so that we're and keeping more inventory on hand. So overall, the supply chain has been negatively impacted by, one, over reliance on China, and two, by reliance on having just in time inventory, which was great because you didn't have to pay to carry a lot of inventory, but now that you can't get inventory, you're sort of stuck because you don't have it on hand. And so I think realization that not relying on China to as great a degree, not relying on just in time, but actually keeping more inventory on hand so that manufacturing isn't shut down. Or for example, one of the reasons why it's so hard to buy Clorox wipes or Lysol wipes out there is there's some chemicals that we're waiting on from China we can't get, so we can't make those products. And so that just plays out all through the supply chain. So I think there'll be some rethinking of that. I hope there will be. Sometimes our memories are short with things like this, but I think there's some. We'll see how it turns out. Our crystal ball gets hazy as we look farther into the future, but our expectation is that this overall will create a net increase of maybe 4 or 5% to that, and for that kind of space. Which, if you think about the billions of square feet that we have of that kind of space in this country, that's a huge impact, and bodes well for major distribution centers like Metro Atlanta.
Well, we've talked about commercial and industrial. Someone had a question about investing in residential real estate, and if there are better areas that we should be looking at.
Well, I think both for sale and for rent residential will come through this crisis well. We went into the crisis, as I said, without a whole lot of excess supply. The residential real estate industry kind of led us into the last recession. That wasn't the case at all this time. So overall, I think we're optimistic about what the residential real estate market looks like going forward. A couple areas that we're looking at in particular, single family for rent, build for rent. Single family is just a very underserved market right now. If you look at past recessions, more people tended to buy in past recessions, although we're seeing people doing both right now. But I think there's this huge generation that we've been building all these apartments for, the millennials, who in some cases are outgrowing that, but who've also done not a great job of addressing for sale housing affordability. And so we have this generation that's kind of ready to get out of apartments, but not quite ready to buy a house. Most of that for sale, that single family for rent market is mom and pop. It's a lot of individual investors. There are a few groups that went out and bought lots of single family homes after the last recession, but the institutional investment in that space is pretty small, and so there are a number of players who are sort of transitioning from the multifamily space and for rent space, and that's just a huge market opportunity in terms of lots and lots of demand. There are much less of that product being built than is demanded. In terms of where the opportunities are, I think we're going to see, there's still the baby boomers are still looking for their last best house, and I think we're going to see people relocating out of higher density urban markets in the Northeast and the Midwest in particular, wanting to relocate to the Southeast. That may accelerate. I think there's a little bit of deer in the headlights in March and April and sort of figuring out, but people have been sitting on the fence about moving in retirement. I think we'll see some uptick in that, and I think that'll be good for the Southeast, including Georgia and Florida.
Great. We had a question about what aspects of your forecast do you have the most confidence in, and what aspects do you have the most concerns about?
Well, I'm not sure which forecast you're referring to. If you're referring to the trajectory of the recovery forecast, I hedged my bets and I showed you three. I think that the summer V probably is the least likely. I think early on in this crisis, we kind of thought that might be the case. The longer climb out that takes recovery out into well into 2022 is probably pessimistic. I think that the forecast of seeing us experience recovery through third and fourth quarter of 2020 and then continue to climb back out through 2021 is the most likely. I think the unknown factors out there are, is there a second wave of this crisis? With the shutdowns ending, are we getting back out there too soon? We still have close to 20,000 new cases a day in the U.S. So we're kind of ending the shutdown at a time that we're really not out of the woods. We're worried about the economy, and rightly so. But maybe sort of jumping back to business before we're really quite ready. So does that stretch things out? We were looking at some data from the 1918 pandemic, and to the degree that history is any sort of a guide, we were comparing metro areas that continued with sort of the stay-at-home sort of model and those that tried to get back to business. Denver was one where people were chomping at the bit to get back to business, and not wanting to do all the social distancing and all that. And actually, their economy took a lot longer to recover. San Francisco, they clamped down on things much more harshly, and their recovery was much quicker and longer. And we saw that pattern across. There weren't really state shutdowns back in 1918. It really was something that it was done more at the metro level. By and large, we saw metro areas. What it seemed to show us is that pandemics cause economic hardship, that social distancing wasn't the result. It was really the pandemic itself, and those areas that sort of resisted shutting down and social distancing took longer to recover. So I worry about that. I think that could be something that we're setting ourselves up for here as well. We'll see.
Greg, thank you. I appreciate everyone staying with us today. And Greg, I know you're doing many of these presentations. I appreciate you taking time out to be with us today. Thank you very much. We also hope that we'll get the slides afterwards. I've gotten several invites. Greg's nodding, so I'll take that as a yes. So we will send out the presentation to everyone who is on this afterwards. Again, I want to thank John Ray and Business RadioX for recording this today. We will have that available as well on our North Fulton podcast site on our website. Our next Economic Recovery Webinar Forum will be next Thursday, May the 21st, and we will hear from a panel of human resource experts on re-engaging employees post-pandemic. So as folks are getting plugged back into the workplace. You can register, of course, for that on our website at GNFCC.com, and you will receive the call information for Zoom afterwards. Again, thank you so much to everyone for being with us today. Thank you to Gregg, and we hope that y'all have a great rest of your week.